that is called the capital asset pricing model. Okay? You won't ever really hear anyone refer to this as the capital asset pricing model, so we're going to start using its acronym. Okay? Its acronym is CAPM. That's whenever you hear anyone talking about this model, it is CAPM. Okay? And what CAPM is actually the model in which we determine how to come up with that required rate of return. Okay? So we've seen this before, right? Our required return is equal to our risk-free return plus that premium for risk. Okay? But we have to come up with what this risk premium is. Okay? We have to isolate this between the firm level and then the market level. Okay? Because it's not just enough to say that we are going to buy this stock and that it's based off of market level risk. Okay? So CAPM actually just looks just like this. Okay? Is that we are looking at this, is that we're showing is that we have this risk-free rate, right, which we know is U.S. Treasuries. Okay? And then we have two factors over here, right? We have the risk premium on the market, right, which this is that S&P 500. Okay? And that is itself is equal to the risk premium on the market minus the return on the market minus the return on the risk-free rate. Okay? It's the difference between the total market rate and the risk-free rate. Okay? Because the reason we're separating this out is that we already have the risk-free rate right here. So we can't double count it. Okay? Now, beta. Okay, this B. That B that you're seeing there, that's a beta, the Greek letter beta. Okay? And this is essentially our correlation. Okay? We generate this beta through regression analysis, which is basically looking at the long-run relationship between that individual security. So this is based off of an individual stock. Okay? It's based off of the individual stock and the overall market. Okay? So our relationships here is that if we say we have a beta equal to 1, okay, this means that it is correlated with the market. It is perfectly correlated with the market. If we have a beta higher, let's say we have a beta of 1.5, what that means is when the market moves, and let's just say when the market moves, the individual security, the stock, will move more. Okay? That individual stock is moving more. So it is actually a riskier stock. Okay? When beta is greater than 1, that is riskier than the market. And so what do you think that means about a beta of, say, 0.5? Okay? It moves less. So does that mean it's more or less risky? Right? A beta of less than 1 is less risky than the market. And we'll actually go into this a little bit later and actually figure out how we're going to do these computations and figure out on CAPM. Okay? But basically what we're coming up with right now is that this is actually going into how we actually compute that risk premium. Okay? How we compute what the required return is on that stock. Okay? We just use it as an input into our models, but this we're going to start actually getting in here and figuring it out. Okay? So now we want to figure out why exactly do stock prices change? Okay? Why do stock prices change? Stock prices change for a variety of reasons, right? But if we recall, is that we have this model here, the Gordon growth model, right, which is basically our dividend next year divided by R minus G, right? There's only 3 inputs in here. There's only 3 inputs, right? And this seems, okay, you know, why are stock prices going to be fluctuating, bouncing around all over the place? Simply put, the reason being is that there's a number of changes that can occur, right? We can have a change in the risk-free rate, right? The Federal Reserve could make some changes with monetary policy, right? And they could have a change in bond yields, right? Because everything's indexed off of that risk-free rate. Okay? There could also be a change in sentiment, generally speaking, with the market risk premium, right? They might say, oh, stock are severely overvalued or undervalued. We need to make sure we get enough compensation on those. Okay? This can base off of the economic climate. The beta can change. We can have, this is more of the change in individual. Okay? This is, in the event of oil price changes, there's going to be changes in refineries and other, those that are based around oil production. There's going to be changes in the beta. This is basically how risky they're going to be. We can also come up with the different expected growth rates. And right, this is going to be on an individual level as well. Okay? This is going to tell us, do we expect this company to grow more or grow less? And this can change from moment to moment as we come up with new information. Okay? And then we can also have dividends that are going to change. The company could announce that they're going to change their dividends. They could do a whole bunch of different things.